Elon Musk is preparing to release Tesla's first quarter earnings this Wednesday. While Tesla has had record deliveries so far this year, they announced price cuts early in January that shocked analysts and competitors, but at the same time will likely hamper the company's margins and profitability going into these earnings results. While this is just a single snapshot within Tesla's long-term journey of transitioning the world to sustainable energy, there are some near-term dynamics that may support these markdowns for Q1 and going forward for the remainder of the year. Tesla's decision to reduce prices may have spooked Wall Street investors, but it's necessary to scale up the production of Model 3 and Model Y and make them more accessible to the masses. Although undercutting competitors may be a side effect, the ultimate goal is to still maintain Tesla's industry-leading margins. And before we continue, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and a brand new set of financial data going back 15 years, and it's all freely available. In the first quarter of 2022, Tesla delivered almost 423,000 electric vehicles while producing over 440,000. This was a record for the company, growing deliveries 36% over last year. Elon Musk's ambition, however, is to average 50% growth. So to secure this goal, it means that every quarter should be on average 50% higher than the previous year. While 36% growth is impressive, this so far puts Tesla a bit behind on this year's plan. Nonetheless, they can quickly catch up in the second quarter since we saw shutdowns at Gigafactories Shanghai last year, meaning Q2 will be a much easier compare for Tesla. If they once again do exactly what they did this quarter, but in the second quarter, that would already lead to 66% growth, but it's possible that Tesla does even better. That's because Tesla's Giga Berlin and Giga Texas seem to be on fire, with Berlin surpassing 5,000 vehicles per week late in the first quarter and Texas doing over 4,000. This is incredible when taking a step back, since most of Tesla's competitors, including massive auto manufacturers like Ford and GM, are still lagging even Giga Texas's results alone. With 4,000 per week or a run rate of 200,000 EVs per year, that's more than many of these established automakers, demonstrating the speed and power of Tesla's Gigafactory investments and their ability to quickly build new ones, which is really just getting started. Tesla is in the midst of expanding its major factories, including Giga Texas and Berlin, as well as Giga Nevada, which could all contribute to a stellar year for the electric vehicle maker, while Giga Mexico is already in the works to potentially begin contributing next year. Demand problems at Tesla are always a go-to narrative for the media, and this has been the case for years. But Tesla has a long sales runway since Elon Musk has directed the company to continue cutting costs, meaning they can persistently hit larger and larger market segments of the automotive industry as they access more customers by making the vehicle more affordable. Currently, Model 3 and Model Y have barely scraped the surface of the auto market given their price levels, and they'll continue to get more accessible as Tesla reduces the cost of manufacturing these vehicles. We even saw during the quarter that after Tesla's huge price cuts, they did raise prices slightly, perhaps to capitalize on the higher demand, or perhaps to balance out their margins, keeping them healthier than Wall Street expects. But if anything, this quarter was production constrained, as we'll talk about more in a moment. Now, one exaggerated cause for concern was the shortfall in Model S and Model X deliveries of only just over 10,000 in the quarter, versus 17,000 last quarter, even though production remained high, near 20,000 in both quarters. However, Tesla has once again begun shipping these higher-end models to Europe, which they haven't done in 2 years. They need to batch these vehicles onto large boats to make sure they're using the infrastructure properly, and then this takes much longer to ship overseas, meaning there were likely thousands of vehicles in transit, especially since Model S and X are only built in California. And because these are higher-end cars with high margins for Tesla, this could be a headwind for profitability in the quarter. Now, one thing that was interesting is that Tesla has been building up inventory for Models S, 3, X, and Y quarter after quarter. 4 quarters ago, they produced in excess of almost 4,000 vehicles above what they delivered, and this number grew to another 22,000, and then an astounding 34,000 last quarter. meaning that in just these last 3 quarters alone, there are about 60,000 cars that haven't yet been delivered. Now, if the current trend were to continue, we'd expect maybe 50,000 in excess this quarter. But instead, the trend seemed to change, with production outpacing deliveries by just 18,000 cars. And we know that about half of these are because of the Model S and X European shipments, so really only about 9,000 excess vehicles, which is a major decline from the prior trend. Again, the media points to slowing demand, but Elon Musk and Tesla continue to tell us that they're trying to flatten out deliveries, meaning that instead of having a spike in deliveries at the end of every quarter, which is extremely expensive, they ideally want to deliver a consistent number of cars every day that gently grows throughout the quarter as Tesla expands. And so Tesla basically had to ruin their previous delivery strategy, which was hitting bottlenecks anyways, and in a sense start from square one and work to optimize this new strategy. So for example, in an ideal world, let's assume that it takes exactly 2 weeks to deliver each Tesla vehicle. That means anything produced after the second last week in each quarter doesn't get delivered in that quarter. Currently, Tesla produces 440,000 cars per quarter, and so 2 weeks worth of inventory, which is about 15%, is roughly 60 to 70,000 cars, which is about what Tesla has built up in the past year. And so under this new smoother delivery schedule, there simply has to be leftover inventory at the end of each quarter. If there was no inventory, it would mean that there was a delivery spike to get every vehicle delivered by quarter end, and then they would need to build it up again, which is not what Tesla wants. So this new strategy allows for more consistency, even if there is a large inventory at the end of each quarter. That said, once deliveries have become smoother, in order to further optimize and reduce inventory, since inventory also costs money, Tesla would need to reduce that 2 weeks number from the time a vehicle rolls off the production line to when it's delivered to a customer. Now again, while Tesla is making these changes, which are painful in the near term, it will benefit them greatly longer term. In the same way that we've seen them rewrite the software for tens of different chips and microcontrollers in order to add more suppliers and completely fix their supply chain, which is paid out in spades versus many other large and small automakers who are still struggling to get components and are even still complaining about chip shortages, something that Tesla has solved long ago. Tesla's smoother delivery initiative is the alternative to simply selling cars into dealerships and then having to shut down factories, as we saw General Motors recently do, in order to maintain optimal inventory levels, which is code for too much inventory. Now for the upcoming first quarter results, Tesla's revenue will likely be impacted due to the price cuts, and here I've assumed a 20% reduction in vehicle price from Q4 of last year, when prices were about $52,000 on average, to this quarter where the average price is estimated to be $42,000. Now this may be a worst case scenario, since most of Tesla's vehicles saw smaller price cuts than 20%, although their top selling Model Y did see a 20% cut. Also, the aforementioned shortfall in Model S and X deliveries this quarter due to the European deliveries could hurt revenue. But that said, on the cost side of things, raw inputs into Tesla's business may have fallen faster than anyone thought, meaning that the price cuts may not be as impactful to the bottom line profitability as people think. For instance, in my lithium video from just 2 months ago, I explained why lithium prices were unsustainable at such high levels. At the peak of $88,000 at roughly 5 kilograms of lithium per vehicle, and with Tesla aiming for 2 million vehicles this year, it would cost Tesla $880 million, which is a massive expense for such a small part of the battery. However, lithium carbonate prices have crashed 60% in just 2 months' time. Now, Tesla has longer dated contracts, as we discussed in the lithium video, so rising prices wouldn't affect Tesla immediately anyways. But what's interesting is that when Tesla was raising vehicle prices, CFO Zach Kirkhorn talked about how the company tries to forecast its future costs to be lined up with its future sales. And so because Tesla previously had supply chain issues and delays, it would have taken 6 months or up to a year to deliver a Tesla to a customer. So the price of a Tesla being sold today would need to reflect the cost to build that car in 6 months to a year from now. And so looking at just lithium, the price was exploding higher, meaning Tesla needed to jack up prices to keep up with what lithium prices could have gone to looking a year ahead. But now we've seen lithium prices completely reverse their trajectory and come crashing down, meaning that Tesla's aggressive price increases to keep up with lithium and other materials skyrocketing and potentially going even higher are no longer needed. So Tesla can easily drop prices to some degree since the forecast for lithium is much lower, and they've also fixed their supply chain such that they don't need to predict costs 1 year out, now that it's just weeks or months. So that relieves a huge amount of cost pressure on Tesla and makes forecasting easier and more accurate, which justifies the price cuts and therefore may not hurt margins as much as people think. Another thing that could help offset the impact from Tesla's price cuts is the growing energy business. In this Megapack video, I talked about how Tesla Energy could help reduce vehicle prices since CFO Zach Kirkhorn discussed looking at Tesla's entire business as a whole in terms of margins. It essentially means that while auto margins can get hit, Tesla Energy could make up for it. While the energy business appears to be growing extremely fast thanks to Tesla's Megafactory in Lathrop, California, which is ramping up Megapack production, energy will still make up a small portion, around 5%, of Tesla's overall business in the coming quarter, so it can only prop up the auto business so much. Now, I've slightly tweaked each line item in my estimate for this upcoming quarter, but the real change is in the automotive sales given the price cuts, where I've estimated the 20% drop in revenue per car. Given these numbers, I'm still estimating about $1 per share in earnings, which is a 17% decline from last quarter, even though Tesla sold more cars in this current one. The analysts are also expecting the price cuts to have a massive effect on earnings, as they're estimating just 86 cents per share, or a 28% decline from the prior quarter, which is possible given what I've previously mentioned, including the lower Model S and X sales this quarter. So we'll see these headwinds battle the tailwinds of a stronger energy business and still record vehicle sales. Now, regardless of these quarterly results, Tesla continues to work to structure itself competitively for the long term. These price cuts that have all the analysts on edge are also very positive for Tesla in putting pressure on their competitors. We've seen Ford admit that its EV division loses billions of dollars, and Ford is one of the top-selling EV brands in the US, which means everyone else is likely in a worse position. Coupled with that, as of today, many electric vehicles are losing their $7,500 tax credits, including Volkswagen's ID.4, which has just seen all of its credits disappear. All Tesla models still get the tax credit, save the Model 3 rear-wheel drive, which qualifies for $3,750. But this again makes Tesla, specifically the Model Y, look much cheaper relative to others and relative to gas cars. And so as EV market share over the next few years in 2025 and 2026 grows to become 40% or 50% of the entire car market, this won't end well for many automakers who will see their ICE businesses slowly vanish and their money-losing electric vehicle businesses take hold to become a much larger part of their portfolios. Therefore, the highlights from Tesla's imminent financial results will be less about an earnings snapshot and more about looking at Tesla's progress in building out its infrastructure and vehicle cost structure to remain well positioned for years to come. So what do you think are some other near-term dynamics that may support Tesla's markdowns during the quarter? And what actions is Tesla taking today that will benefit the company in the next 2 or 3 years? Don't forget to watch my last video on how Apple Park is powered by Tesla's Megapack. Please hit the like button and subscribe, we would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.